Hi there.
Hi, Angela. How are you?
I'm good. How are you?
Doing well. Doing well.
Good. I'm
Yeah.
I'm stressing a little bit because I realize I've always done I haven't done a webinar before, but
Okay.
I think we'll be fine. And
Yeah.
um
As far as like just managing the Zoom or
yeah, like are you able to share your screen? I just want to
oh
make
yeah, we Nick was gonna plan to share the slides that we have.
okay.
Yeah, so no worries there. Um
And then when you're talking, will I disappear? Hey Nick, how are you?
Hi, good. How are you?
I'm good, thank you. I was thinking we probably should have done a practice before 4:55,
That's all right.
but thank you both for being here.
yeah.
No problem.
Um,
I don't know if you I know there's a way where you can like remove your video and then it's just me and him, but I've never
yeah.
done it before, honestly. So I'm
Okay.
not sure.
I'm not sure either.
Are you able to share your screen? Just want to
I'll
make
test it. I should be.
thank you.
Says I have to send a request. I sent a request.
Yeah.
Did that work? Yes, it did.
Okay, good.
It's coming through okay.
Yep. And then I'm just wondering how it's not hide self view. Can you still see me? Or I just can't see me.
Yeah, we can.
No, sorry.
Okay. You want to be seen?
No, I guess at the beginning, but then not.
Yeah, I understand.
Here we go. View, hide non-video participants.
I'll pull it down for now.
Let's see. I know what a non-video participant is.
I'm wondering if that just means if they don't have.
Attendee view, speaker. Well, I think we'll be fine.
Yeah, I mean, if worst case, you could just like turn off your camera and mute your screen.
Yeah, I'll do that.
Angela, if it's all right at the end, so EITC was the last thing we had on the list, but I was thinking it might be beneficial to just have you speak briefly about how it's benefited the organization and how it typically looks when they
Hmm.
do that. So if it's okay, I may throw that to you at the very end.
Yep, that's perfect. Thank you. We
Mhm.
have about 7 people signed up,
Okay.
but when I was looking at our EITC webinar, we had about 100 views last year. So,
Good.
and we probably had about the same amount of people. So, I think, we'll put it in our newsletter and put it out. And normally
Great.
that gets people.
Good.
So thank
Good.
you both so much.
Yeah. Happy
Yeah.
to do it. Thanks for the opportunity.
Yeah. I like your dinosaurs, Kevin.
I get a lot of compliments on those.
Yeah.
Those are my son Bo's
Oh,
artwork. So the
oh,
Boasauruses.
oh, that's very cute. How old is he?
He's 4.
Oh,
Yeah.
and you have 3 kids.
Yep, 3, 2, and a baby.
Oh my gosh. Wow.
Yep.
So you're busy.
Yeah, a little bit more so as of the late. Uh, but yeah, it's all good.
You must feel like going to work is a vacation.
Don't tell my wife that.
No, no, of course not.
Sometimes I do.
Funny. I think, well, I'll give it till 5 and then I'm just going to get started and then people can jump on. Yeah, they'll just jump on. So if that's okay
Yeah.
with
Yeah,
you.
that's fine. With it recorded, I guess.
Right, yeah, because I guess the more you're just trying to record it. Gotcha. Yeah, that
Mhm.
makes sense. Cool.
Um, All right, I'm going to get started, I think, if that's okay with you both.
Yeah, absolutely.
Ready to
Okay,
go?
great, thank you. All right. Good evening. Welcome to our webinar on smart giving. Thank you so much for being here today. I'm Angela Marks, the founder and executive director of Reading Aloud. At Reading Aloud, we believe that every child deserves the chance to become a confident reader. We provide one-on-one structured literacy tutoring to struggling readers across Philadelphia. We are the only nonprofit in Philadelphia to provide the highest quality structured literacy tutoring that is delivered and by certified and experienced tutors. Right now, we have about 100 dedicated tutors working with around 400 students across the city. And behind every single one of those tutoring sessions is a donor who made it possible. Our supporters are the reason children who once dreaded opening a book are now raising their hands in class, discovering joy in reading, and unlocking new opportunities for their futures. We are deeply, deeply grateful to each of you who shares in this mission, and we're thrilled to be here tonight to talk about how thoughtful, strategic philanthropy, smart giving, can magnify that impact even further. I'm really delighted to introduce to you Nick Stumpo and Kevin Wager of Hightower Advisors, who have and continue to be wonderful friends of Reading Aloud. Nick Stumpo earned his Certified Financial Planner certification and graduated with a degree in business from Penn State University and an MBA from Villanova University. Prior to joining Hightower, Nick spent 13 years with Vanguard. And Kevin Wager, also a certified financial planner, has been with Hightower for more than 7 years, where he has the privilege of helping busy people plan for their retirement and future goals. Gentlemen, thank you so much for being here today. This is so out of my realm. Sometimes I feel like it's life insurance where I understand it in the minute, and then an hour later, if you ask me to explain what I just agreed to, I have no idea. So I am very, very grateful to you for helping us this evening. If anyone has questions and answers, please put them in the chat. If you have any questions later, please feel free to email me. I will follow up with an email. And if I don't know the answer, which is very likely, I will, Nick and Kevin, I'm sure, will be happy to help us out. So thank you both so much for being here. And I will let you go ahead.
Angela, thanks so much. Thank you for inviting us and giving us this wonderful opportunity to help educate our viewers here on some smart giving strategies. And thank you for the work that you do with Reading Aloud. We're happy to be affiliated with the organization. So what we hope to share tonight, first off, just a quick little bit about our firm. Thank you for the kind introductions. For those that might not be familiar, we're located in Wayne, just outside of King of Prussia. And Kevin and I, as you said, are both certified financial planners. And really the hallmark of what we try to do at our firm is help people with all aspects of their financial life through holistic planning. And one space where that really comes into play, of course, is charitable giving. There are a variety of different strategies that you can use to help support organizations that you care about, like Reading Aloud, but also have very beneficial outcomes for you as a donor. And so that's what we're going to focus on tonight and take you through. As you said, happy to address any questions as they might come up, as well as follow up with questions this discussion may generate. And with that, I'm going to go ahead and share my screen and also invite Kevin to take us through our first few strategy introductions.
Perfect. Thanks, Nick. And for those watching and viewing tonight, thanks so much for your time and joining us. So I want to spend a little bit of time just talking about the differences between But the normal ways that's one might think that they can gift to charities like Reading Aloud that they have an affinity towards, but also just making sure people are aware that there are other ways, such as leveraging your nest egg, leveraging your investments to satisfy that gift. So that's where I'm going to start, and then I'm going to shift to kind of show you the real tax benefit, the tax savings that you could derive from the strategy, and then also another really smart tool called a donor advised fund. So yeah, so to kick it off, the income tax benefits when making charitable donations. So the IRS is really trying to incentivize folks to support charities such like Reading Aloud that are doing such important work for the community. So depending on whether or not you use cash or securities, you get a little bit different deduction treatment, I would say. So from Reading Aloud standpoint, they're completely indifferent if, or I shouldn't say completely indifferent, but they don't care if they're getting cash or they're getting securities. It's both are definitely helping them. But from the individuals or the donor standpoint, there are some nuances to be aware of. So first, we just outlined on the left-hand side here, the differences in those deductibility. So if you're using cash and donating to a public charity, you can deduct up to 60% of your AGI. Your AGI is basically your taxable income. If you're using securities, you can deduct up to 30% of your AGI if you're giving to public charities. So we're just to put a round number on that. If your taxable income is $100,000 and you're donating cash, you could, in theory, deduct up to $60,000 off of your income when using cash, and then $30,000 if you're using securities. The other big tax implication that you just need to be aware of is capital gains tax, especially when you're thinking about leveraging the portfolio to satisfy your gifting. So capital gains tax is the tax that you owe on investment growth. So if you buy XYZ security, whether that be a stock, bond, mutual fund, exchange traded fund, if you buy it, that sets your cost basis. And then future growth, and ultimately you sell it, that future growth you have to pay a tax on. So if you were to sell that investment within a year, you're subject to short-term capital gains, and those are taxed at ordinary income rates. So with this new tax bill that was passed this year, the highest tax bracket is set at 37%. So plus the 3.8 Medicare surcharge, the highest ordinary income rates are called 41%. If you were to hold an investment for longer than a year and then sell it, all of that growth is taxed at capital gains rates. Those are much more attractive, much more advantageous. The highest capital gains rate is at 20%, plus the 3.8 Medicare surcharge. So call it 24% all in. So 40 versus 24, significant difference. So just wanted everyone to be aware of the differences there. When it comes to using stock or an investment to satisfy your gifting, the holding period is really important. And that's because if you were to use an investment or a security that had short-term gains, you're only able to deduct the cost basis, or essentially what you paid for it. And that will likely be less than what it's worth, the fair market value. So it's really important that when you're considering supporting a charity, and then in your situation where it makes sense to leverage the portfolio and use a security, it's really important to choose and analyze those long-term gains to leverage to satisfy that gift, because you're able to deduct the fair market value, which is likely going to be higher than what you paid for it. So some of the use cases for where investments might make more sense than cash, oftentimes that can be specific to the individual, but anytime that there's, like I mentioned at the bottom of the page there, anytime there's significant appreciation, obviously you want to be able to essentially wipe your hands clean of that embedded capital gains tax. So, and then also just, you know, for those out there who might have legacy positions that where this XYZ stock, for example, represents a large portion of one's portfolio, that's what's called, that is what we call concentration risk. That could also be a good candidate to use to satisfy your gifting. So a lot there, but I think the next slide is a really good just representation of the power of using securities instead of cash. So what we're looking at here is a hypothetical scenario where you're making a $10,000 gift. On the left-hand side, it shows how the income tax is saved on the stock and the cash is the same, right? You're able to use the fair market value and the cash. And so if you're using $10,000 worth of stock or $10,000 worth of cash, it's the same thing. But the big tax savings in this example, the cost basis or what you paid for the security many, many years ago was $2,000. So that $2,000 has grown to $10,000. So there's $8,000 of capital gains. In this hypothetical scenario, this individual is subject they're paying 15% capital gains rate plus the 3.8 Medicare surcharge. That's where you're getting the 18.8%. That percentage on the $8,000 of gains gives you the $15,004 capital gain tax saved. So that's just, again, it's a significant tax savings when you're essentially getting the same tax deduction in both scenarios. And so to further compound the benefits of this strategy is, in this hypothetical, you're gifting the $10,000 of stock rather than that cash that you did have. You then take the cash and repurchase that stock, the same amount of shares. And what that essentially does is resets your cost basis. So you're not only using the stock to satisfy your charitable goals, you're getting the tax deduction on the fair market value, you're avoiding the embedded capital gain, and then you're also resetting your cost basis. So it's really a win-win situation. And so the other tool that I want to make sure that you're aware of that really goes hand in hand with this strategy is what's called a donor advised fund. So a donor advised fund, you can kind of consider it a charitable waiting room, if you will. So what a donor advised fund allows you to do is make contributions to this fund. You can invest those contributions. All growth is tax-free. And then you have the remaining, basically your remaining lifetime to decide where those contributions end up. Hopefully they'll end up in organizations just like Reading Aloud. So why would somebody use this rather than just gifting right to the charity? And so the reason that you would do this is I'll give you a kind of a use case example. Maybe you're someone out there who's close to retirement. You're at the end of your career and you're at the highest earning point in your career, and you're in the highest bracket. And it's likely that maybe next year or in a couple of years, you're going to retire and you're going to be in a very low tax bracket. So in theory, you'd want to take advantage of these last couple of years where you're in an elevated tax situation. You're going to value charitable deductions the most in these last couple of high income years. And then let's play hypothetical again and say that person, you are charitably inclined. You want to support causes that you have an affinity towards. And let's play pretend it's likely that that you could give away, $5,000 a year for the next 20 years. So 5 times 20, that's $100,000 that it's very feasible that you could donate to charities that you have an affinity towards. So what a donor advised fund allows you to do is put all of that money up front into 1 year when you're in a high income tax bracket and you're going to value that tax deduction the most. So you're able to capture or bunch a large charitable deduction in the year you need it most, and then you can decide the rest of your life where it goes or to what charities you want to donate it to. So those people close to retirement in a high income bracket, these make a lot of sense. Or for maybe you're a business owner out there, or maybe you an executive that has equity compensation. There's a selling of a business or whatever it might be. You have a spike in income, and maybe you just have an unusually high income year in 1 year. that's another situation where a donor advised fund would come into play, because you're able to essentially sock away multiple years of charitable deductions in the 1 year that you need it most. So yes, very, very, very smart tool. Like at that $100,000 example that I used, just to give people a sense of the tax savings that comes with that. Again, if we're using that example of 32%, if you make $100,000 donation to a donor advised fund in that 1 year where you have a spike in income, you're essentially lowering your taxes by $100,000. 32% of that would be tax savings of $32,000. So it's a very significant tool that you could leverage to make tax smart giving in the current year and then subsequent years as well.
All right. Thank you, Kevin.
Yeah.
So switching gears a little bit, we wanted to talk about some strategies that maybe are more applicable as folks age and reach later stages. And so it's a very nice thing in this country that a lot of people have saved significant amounts of money in IRA accounts, individual retirement accounts. And those accounts, just to set the basis here, if you will, when you contribute to an IRA account, your contributions are not taxed. And the money that grows in an IRA account over its life is not taxed either. But that means distributions from IRA accounts, once you've reached certain minimum ages later in life, are taxable. Because the IRS has allowed you to avoid the tax on the contributions and the growth, eventually they want to get their hands on some taxes, as you can imagine. And so there are some ways that you can be creative with your charitable giving to minimize or eliminate parts of that tax. And of course, take advantage of the impact that you want to have in donating to organizations like Reading Aloud. So the first idea we wanted to talk about is something called a required minimum distribution, and as well also a qualified charitable distribution. So a qualified charitable distribution, if you've reached the age of 70 and a half and you have IRA accounts, you can take distributions from the account, and rather than receive that money as income and be taxed on it as income, you can instead direct the money directly to a charity. That's what's called a qualified charitable distribution. What's key here is the money has to go straight to a charity like Reading Aloud. You can't actually take possession of it. So if you receive a check in your own possession and then write a check to the charity, that unfortunately doesn't satisfy the requirements. So you want to be careful about the way that you enact this, but most investment and brokerage firms are extremely well versed in this. It's a very common strategy. And so with a qualified charitable distribution, you can take money out of the IRA, designate it to one or more charities to go there directly. And what happens from a tax standpoint as a donor is you've avoided the receipt of that income entirely. And what that means is you're not taxed on it, which is really powerful, right? So you've had tax-free contributions, tax-free growth over the life of the account, and then you accomplish your charitable giving with no tax as well. So a really powerful tool. Again, that's for folks who have reached at least age 70 and a half. There's this strategy can make sense in a couple of different situations. You might be in a situation where you don't have enough itemized deductions. So Kevin talked about itemizing deductions through cash or security donations earlier, but not all folks are in a situation where they can itemize deductions. The standard deduction might make more sense from a tax planning standpoint, but you still can do these qualified charitable distributions in that case, which is really powerful. Once there's some nuance to this, but once you reach age, for most folks, 73, and depending on your birth year, for some folks, it's age 75. The IRS says you have to start drawing down IRA accounts if you're not already through something called a required minimum distribution, or an RMD. And that's basically when the IRS says, you've got to take money out of these accounts. We've let them grow for so long. We've got to tax it eventually. So this is a challenging situation a lot of folks encounter. because it creates taxable situations later in retirement that maybe they want to avoid or didn't plan on. That's another time where using the qualified charitable distribution can be really powerful to accomplish your charitable giving desires, because the qualified charitable distribution can satisfy this required minimum distribution requirement, either all or in part. So again, a great time to think about it. RMDs can often push people into higher tax brackets because of the required amounts that need to come out. And so the qualified charitable distribution and a thoughtful tax planning strategy is a great way to help lower your overall income and perhaps even keep you under a threshold where you might bump into the next higher tax bracket because of the RMD. So, some different moving parts here. They sound perhaps more complicated than they actually are to enact, but there's a lot of options here to get creative. Use the power of all that compounding and tax-free growth that your accounts have had over their lifetimes to accomplish your charitable goals, and of course, avoid the tax on them on top of it. There's a couple other strategies we wanted to talk to you about that are more for later in life, again, perhaps even beyond your early 70s when these RMDs kick in. One is life insurance. We find that a lot of folks purchase life insurance when they're working as um, either as an investment or a risk mitigation tool. But as they age and acquire more assets, build a larger nest egg, they may not need that life insurance anymore to ensure that they can live their lifestyle or provide for, their heirs in the event of their passing. And so it's possible to name a charity as a beneficiary of your life insurance. That's a really popular way that folks try to do some more advanced estate planning. Naming a charity as a beneficiary for your IRA, or excuse me, for your life insurance, also can help remove that from the proceeds from your estate, which factors into estate calculations and estate taxes. There's also a tool called a charitable remainder trust, or CRT, and that's highlighted here. And the way a charitable remainder trust works is you take money that you would like a charity to receive at your demise, and you make what's called an irrevocable contribution into the trust. So the trust is a separate legal entity. You place assets in the trust. And I think a good analogy to think about is you're almost giving a tree away, but continuing to eat the fruit. So what I mean by that is the assets you place in trust, you can't pull them out because it's an irrevocable contribution, but you can still derive income off that trust, which you can see illustrated here for the remainder of your lifetime. And then eventually, as at your passing, the remaining assets in the trust pass to the charity of your choosing. This is again a situation where you're removing assets from your estate, accomplishing charitable desires. Obviously, later in life, because at your passing is when these assets actually move to the charity, either through life insurance or the charitable remainder trusts. But they can be really powerful estate planning tools that help mitigate potential estate taxes and, of course, help organizations like Reading Aloud. And then the final strategy we wanted to talk about with you this evening is the Pennsylvania Educational Improvement Tax Credit. And I think this is something special to highlight because it's first off unique to Pennsylvania in many ways, and also Reading Aloud has benefited really well from this program over the years. So I'll briefly introduce it, and then I want to ask Angela just to speak a little bit about its impact to Reading Aloud. But the way the EITC program works is if you make a commitment of you can make a 1-year commitment or a 2-year commitment, but effectively by making a commitment, you are electing to redirect your tax dollars, your state tax dollars, away from the state to a charity like Reading Aloud, and specifically educational organizations like Reading Aloud. By making a 2-year commitment, you can capture up to a 90% state tax credit that comes off of your state tax liability, dollar for dollar. So you're not necessarily removing, or what should I say? You're not necessarily in a situation where you don't have to pay taxes, but rather the money you would have paid on taxes is instead going to an organization that you care about, and you can be assured that you're having more impact and really having say over where your dollars go and how they're spent. So by capturing that 90% state tax credit, that can lower your state tax liability significantly. And then for the remaining 10% that's left, you can also then capture a federal tax deduction. So there's multiple layers to the benefits here, which is really nice. Reading Aloud has partnered with a group called Friends of Education to help them with these credits, obtaining them, and actually administering this program. So Angela, would you like to talk for just a couple minutes on what that's looked like and the impact it's had on the organization?
I will happily talk about that. To say that I am in love with the EITC program is an understatement. It's just been a huge boon for us. We received last year, I think it was over $100,000 in EITC credits. And that's allowed us to support students in public schools in K through 3. And we have a long waiting list of students who need our support. This EITC funds has enabled us to pull a lot of those students off that waiting list and support them immediately. So those funds have been hugely helpful to us. And what I hear from donors, as you said, we partner with an organization called Friends of Education. And they make the process very easy. They can, they will, let you know exactly what you need. They'll provide you the forms. They do all the reporting, provide you all the documentation you need when you do your tax return. So the process is really very easy. And I honestly can't, I don't think I can over exaggerate how powerful these funds are for us. As I said, we know exactly how much funds we have. We know how many kids are on our waiting list, and we can take those students off and get them the reading support that they need immediately. So I could talk all night about how much we love the PAEITC program, but I'll stop there.
It really is a win-win. You have to pay tax anyway, so why not direct your tax dollars in a way that is really impactful for you and the organization?
Mm-hmm. Exactly. And I would say if anyone watching would like to speak directly to Friends of Education to get more information, I will send out that information as well, and can connect anybody who'd like to.
Wonderful. Well, that concludes what we had prepared in terms of strategies. Angela, thank you so much for having us. Were there any questions that came through that we could address at this time? I haven't been monitoring the chat while we're talking, sorry.
I have been monitoring the chat. I don't see any right now, but
Okay.
I suspect we will get some afterwards. So if that's okay with you both, I will reach out as and when we get those questions so we can get back to people.
Absolutely. We'd be more than happy.
And I am so grateful to you both. This is so helpful. As you know, our donors just mean the world to us. It allows us to do what we do. And if there's a way that, people can give, obviously it benefits us, but if it can benefit them as well, then it truly is a win-win for everybody. So thank you both so much. I'm very appreciative.
Thanks for having us. We appreciate it.
All right. Take care. Thank you both. Have a good night. Good night, everybody. Thank you.